Okay guys, welcome to another segment. I'm sorry took me so long to start creating video again, but I'm here. I don't want to bore you with my personal stories. But I'm going to be looking at all the pairs I trade, which is 1, 2, 3, 4, 5, AUD, USD, GBP, USD, Euro USD, Gold, and GBP, JPY. I added this one for recently. So this is the weekly chart for AUD USD. This is the weekly chart for AUD USD. So I'm going to I'm starting from the weekly chart. So first of all, I'm going to clear all this. I'm going to clear all these markups here so that we can get a fresh chart. Delete. We won't get a fresh chart of. So okay, so delete this and also this. So this is kind of a top-down analysis. So this is a weekly time frame. We are going from the weekly, daily, 4 hours down to the 5 minutes. This is where we this is the 5 minutes, and this is where we take our trades from after doing analysis, down to the 5 minutes. So I'm going to mark the weekly time frame with this red line here. The previous week, okay, I'll mark the previous week, the high of the week here, and the low of the previous week here. So actually I was supposed to talk about this week because this was the week we did analysis for, to determine this other candle, the movement of this candle, right? Now we are in the new week just ended, so I will do analysis for this instead. Alright, so that is where the candle started and ended, and I'll put a red line also at the middle just to so this is only what we do on a time frame, on a weekly time frame. Then we're going to move down to the daily time frame. So as you can see, this is where the week started. The week started here and it went up that previous week, so we're going to go to the kind of 2 hours time frame. I'll delete this. Alright, so now judging from the 2 hours time frame, what we want to see from 2 hours time frame is possible break of structures. We want to mark out our break of structures, right? So what we want to see here is we're marking out our break of structures, right? So this is the first break of structure. Sorry. First break of structure, second break of structure, came down to this point, more like a liquidity sweep. Then we have another one here, right? So now what do we see here? We saw that as the week started, we saw a liquidity grab. Let me just move this a little bit. So if you look properly, you see kind of a liquidity grab here. Liquidity grab. Then we got a break of structure. The markups can actually take time, so I might not be doing it. So when we saw a break of structure, but what happened before that break? We saw this was what happened. Price went the first time, couldn't break, reacted at the supply zone here, came down and broke. So we are going to we've identified our liquidity grab, right? This is a liquidity break. kind of liquidity break, then manipulation, right? Manipulation. So manipulation, where is it? Manipulation. Then we saw our this one confirms that the market wants to buy, right? Confirms that the market wants to buy. I just call it a couch, our couch, right? So this is kind of a flip. Manipulation is also a flip. So because why is it a flip? Because market tried to break it the first time, couldn't, came back down before it flipped it. So at that point where it flipped it, they're marking out they called fair value gap. Fair value gap. So since market reacted here, we call here in inducement, because any liquidity point resting below a fair value gap is inducement, and we have to look for entry at the next order block after the fair value gap. So if this is the inducement, right, this is the inducement liquidity, this is known as a fair value gap. I do all this markup so that it will stick to my head and it will also resonate whenever I want to, so that I will see my markups and see what to expect from the market. So as we can see, this is the order block we're kind of looking at. This is actually the on the 2 hours time frame, but I don't trade on the 2 hours time frame. I just do my markups on the 2 hour time frame to know the break of structures, because after a break of structure, it is expected that market should come at the discount level, at least at the discount level. So for me, that point that broke the structure and the lowest point, midpoint of it, I call the midpoint the discount level. So at this level, I'm expecting price to come to this level, right? I'll mark it out as a discount level, discount price, and let's just adjust. So we're expecting price to at least come down a little bit here, give us a reaction, then we buy to this high here, this high. But this is what price did. When you go to your 5 minutes time frame, we are going to see what price did, why price did not come down to our discount price to give us a reaction. So we can just literally take our entry from the 2 hours time frame. You understand? There are some people that can just take their entry here, but I don't advise that, because it can be, you can just set your entry here at the beginning of the block here. This could just be your entry here, and you have your entry, and but it's risky because price did not actually, but we're going to see what really happened. Then our stop loss a little bit above this low, understand, 7 pips. Then we target the high, understand. So 1:8, go 1:8 on this trade. So that is it. Entry, exit, and okay, I don't think it's up to 1:8. So but you'll be getting 1:4 on a higher time frame level, you understand. So now this is actually a risky entry. This is actually a risky entry, but I'm going to go to the 5 minutes, or let's say 15 minutes, to do some markups to see where price mitigated, to now know if this level is valid but it's still a risky entry because this right here is our discount price. See this very line here. Sorry, let me go back. So this very box here is our discount box where we expect price to dip in, give that reaction before we buy. But we see that price did not come here, so that's why entering at this point is always a risky entry. If you're entering, just prepare that it might be a probability. So if you're setting your entry here, you can also come and look for maybe a another block below here, and whatnot. So but what price did was, when price was going up, when price flipped, gave a liquidity break, I was trying to go up, price went up the first time, came down, mitigated this breakout block here. Look closely on our 15 minutes, mitigated the breakout block. This is a breakout block, so price mitigated the breakout block, and that point becomes mitigated. Price tried to go up again, failed, came back and mitigated the other block here on that breakout block. So this also is a demand zone. The price mitigated. So we see, what we now see here is supply to demand flip. Price did this, supply to demand flips, supply to demand flip. So price now mitigated the supply zone up here, came down, mitigated the demand zone and flipped it. When price flipped it, what happened? Look closely. I told you we had a fair value gap here on the higher time frame, so I'm going to shift this fair value gap a little bit out of the way. And what happened here? So when price flipped it, we saw what price did. Price came and gave what? A liquidity, just resting below this demand zone that was mitigated. You see why higher time frame level, that higher time frame level was valid. So price gave a liquidity point, and even if you want to, okay, let's say we want to take our entry here, we could have missed it on the 15 minutes time frame, but we can just, so what happened here is we are kind of, if we want to take our entry, considering that there's a fair value gap here, there's a liquidity point here, we can just take this last point here as our entry point, this last liquidity, because if price just grab that liquidity, price will start buying up. So we can still say, okay, on the 15 minutes we call here our entry, and just a little bit below this low here is our exit. So you see how we maximize our profit now to 1:2, instead of 1:4. Now we now have 1:7, almost 1:7. But then again, this is a risky entry. The proper entry is when you have to look for what's it called, you wait for price to break this point here, and this point here. Once price gives you this break, right, price comes to the top here, gives you this break. Now we should be looking for, we should be expecting price to come down to mitigate this zone here, this zone on the 5 minutes. So a demand zone on the 5 minutes after you get a week. It was actually a week, so we'll go to our 5 minutes to see what price did there, because we are going to extend our demand zone on the 5 minutes to see what price did there. So I'm going to be deleting this one because this very entry is a risky entry. I don't usually take this. If you're taking this, it's under probability. You're taking it under probability, so I'll delete this one. This one is risky entry. I don't advise anybody to be taking a risky trade. So looking from what price did here, we see a break here, tapped into our risky entry and give us what? A couch, which is price is actually wanting to go up from that level. The price is actually wanting to go up from that level. And what did we see after a couch? Price came, mitigated this whole demand zone here. This whole demand zone was mitigated, so we could still draw out this demand zone after this break. You understand? After this break, remember this is a 15 minutes break that gave this demand zone. So after that break, we can still draw out. After this break here, we know that price actually wants to go up, then we come draw out this demand zone, this whole zone, and wait for price to tap in. See, price came and tapped in twice. The first tap was here. Price came, tapped in here, and just put it here, because normally this is the best kind of entry. Price is not going to go down below this, so you target the high. Second tap was sweet. This is the second tap. These all on 5 minutes. So this is the second tap that gave this high. So normally we will be targeting, so this is the break. So that's another break. So normally we'll be targeting the weekly high, because that's supposed to be our target for because we are intraday traders, so we're supposed to target. So normally we just enter the entry on the second one here. So these entries are considered the best kind of entry, because this kind of this block here is kind of safer to enter, because price will not dip down into pure entry. So if I enter from here, I go out from here, enter from here, and so if I'm targeting the weekly high, that is 1:3, targeting the weekly 1:3, so I'm getting almost 6.8 RR on this very trade. You understand? So once you get your target met, once you meet your target, what you should be doing again is going back to the weekly, or the yeah. So I'll mark out the next week. Now just bear with me in this video might take a bit long, because I would want to explain some things to you, so that you get proper understanding what we are talking about here. So I think, okay, let's see. All right, so I'm going to mark out the second week, the candle for the second week, with another red line to just to know where the week started. So the next week we have this, right? So I'm going to delete this one, because we are done with that analysis. So I'll go back to my 2 hours. Okay, yeah, okay, I think I've done that one. Go back to my weekly. Okay, so the next one is this one. Now, before I do that, I'm going to draw the weekly high of the previous and the weekly low which we got, and we come back to this. So from here we have a high. The high was broken to give us this week high, and this week's low, and I'm just going to mark it with this. Alright, so we go to our 2 hours to see what we can do. So we took that trade. Now we now have a break of structure. So this was the last week low. Definitely price is going to come and take that low. So when we have this break of structure, this is kind of a liquidity because it's the previous week's low. So we are expecting price to grab that liquidity, so we do nothing. When the week started here, we saw how we got a break without taking the low. So we just know that price will definitely come and take the low. Now when you look closely on the 2 hours time frame, you would see you would see, let's go to 4 hours time frame. Let's go to 4 hours time frame and check out something. Okay guys, so this is the 4 hours time frame. So in the 4 hours time frame, what are you seeing? So we are seeing a fair value gap. Now we are using the 4 hours time frame for clarity so that you will see the candles properly. So we know that this fair value gap will be taken after price takes the weekly low. So we are going to mark it as our fair value gap. It's also a liquidity point. That's why I call this fair value gap liquidity. What is fair value gap? A gap between 3 candles. We see this bullish candle, this bullish candle, and this bullish candle. Now there is a gap in between the three, in between this middle candle. You have the 3 candles, there's a gap in between. So we also see that point as liquidity point. Now after the liquidity point, we're expecting price to come and take the other block below it. So we're expecting price to do this, tap on the other block, and so but we are not going to do anything because it's a higher time frame. So we just call it a demand zone, and we go back to our 5 minutes. You understand? So we've gone back to our 5 minutes time frame, and we are seeing the demand zone we marked. And what happened is fair value liquidity. So price tried to trick us the first time. Normally before you say a fair value gap is properly mitigated, it must come even below, it must come at least close to the 50% of that fair value gap liquidity. You understand? It must come below the fair value gap 50% before you call it mitigated, or also a demand zone. Sometimes a demand zone will not just tap and leave. It must come close to the 50% before you call it mitigated. So but you see the trick it played here. It tapped in the forever gap liquidity and gave a break and give another break. So normally you'll be saying, okay, fine, you'll be using this point as your entry because it has stopped at your demand zone, right? See how we all got taken away? That's why I don't usually take the first entry. Don't usually take the first entry because of this. Because price might just still sweep that demand zone below and before it continues to go up. Okay, so I don't know where I stopped, but from this demand zone, this 4 hours demand zone, a fair value gap. So we're expecting the week started here, right? This is where the week started. We're expecting this low to be taken, the weekly low to be taken. That's the low. After price broke, this is the previous week low. We're expecting it to be taken and price should react from this demand zone. So see this box here that I wrote D. This is a 4 hours demand zone. So but then, like I said, I wouldn't just take my entry like from here. I wouldn't just want to take my entries from this zone up because anything can happen. Anything can happen. Price would want to maybe might want to come and purge even this demand zone a little bit before it continue up. So it's kind of risky. So I don't advise people to take it, even if you know it might play out. Just be a little bit patient and price will give you the best price to make your entry. So what we have to do is to wait for price to tap on our zone, then begins to buy. Now the first people that might enter this trade would think that price is buying. You see how price came back and swept. Now price even gave you a fake break of structure. So that's why you have to wait. You have to be patient enough. Price would always come through and give you the best setup. So you see how price tapped on that demand zone, left it, gave a couch, and even gave another break, signifying bullish. Price is now bullish. So people will start entering from this demand zone. I think I marked it out. So people will not entering from this demand zone here. You see? But then for a smart trader, you don't need to enter. You still need to wait to see the reaction you are going to get here. So for me, I waited because most people will be considering this a liquidity point, inducement liquidity and all. But price, like I said, you will still have to wait because price will still have to react here to give you something. So normally I would be expecting if price want to respect this zone, price should do this. As price is coming down, price will respect it and come a little bit above here. Then I will now take my entry from this demand zone, another demand zone here. That's what I always do if price wants to actually do that. So you see how price came down, respected a little bit, do as if it wants to go up, break, and it later cleared this low, and this is what I call purge. Price will purge that zone and would want to now continue the movement up. So as a smart trader, what you do is wait. Patience is key. So as soon as price purge that zone, what happened? Like I always tell you, price will purge the zone and come up. Price will come up a little bit, and come up a little bit. You understand? Then before you now enter from the demand zone, and boom, you make your money with a very minimum stop loss. So when price purge that zone, I just drew out this on the 15 minutes. I drew out this and I was waiting for price to break this same demand zone it purged. So when it broke that demand zone it purged, the next thing to do is to look for a new demand zone where price would come and tap after purging it. So I call this the reclaimed block strategy. So out. So what you just do is um so this is a fair value gap in 15 minutes time frame. So you extend that. Price might take some days, but it will definitely come to reclaim that zone. You can as well use the 5 minutes time frame to get your block. But if you're using 5 minutes time frame, you have to be very careful so that you don't miss the entry, because price might just give you a sniper entry on the 5 minutes time frame. So that's why I advise, see how price, let's see what price did if you give that sniper entry. So yeah, you see he missed it a little bit, missed it. So what I will expect you to do is just go to 15 minutes and see what are you seeing on the 15 minutes. You can use the 15 minutes block, which is starting from here, the body of the candle, or the wick, anyone you prefer. So if you want to use the body of the candle, this is the block here, you can use the body of the candle because you have a fair value gap there. So price would come 50% at least of the fair value gap and maybe tap on the block before it leaves. So in this kind of setup, it's a very safe setup for you to enter. So you might wait some days for it to fulfill. So but when it fulfills, when it happens, what happens here? This is it. Boom. You got that entry and your stop loss was just here, because price, if our price might not even come too will not even give you what's it called, floating loss. So you're targeting this high. So price is what it did, and we got a 1:6 Aurora, which is a very good entry. So this entry is kind of a safe entry, you understand. So this is a very good entry. So we entered, we made some money here. So that is it. So from here to here, from on the 18th of from April down to the 30th of April, that's when we got our entry. We were waiting 18th to 30th. You know how long it took? Almost more than 15 days. So we had to wait for the perfect entry. That's why you don't have to trade a single pair. That's why we are trading all these pairs, because while you're waiting for this one to play out, you might get entry on either any of these ones. Understand? So the goal is to get a perfect entry so as to make money on forex. So that is it for our entry setup for AUDUSD. So this is how we do our markups. This is how we do our markups. And what we have to do again is to now go to the weekly time frame. Let me try and project what will happen for the new week, which is starting on the 7th of on the 7th of no, it's not on the 7th. It will be starting on the 5th, or the 5th of the 5th of May. 5th of May, not good at. The 5th of May, we're expecting so okay, so for next week, what we are doing is we are going to use the 12 hours time frame to do our markup just like we did before. So on the 12 time frames where we have seen the break of structure, so what we are expecting price to do is come to the discount level. And how do we mark our discount level? From the break, the high to the low would be our range. So we are marking from this high to this low here. and the 50% of that range would be our discount zone where we expect price to come. So as we're expecting price to come, we do nothing. We just watch the market take its course and we wait till the price gets to this discount zone. At least we're expecting price to come down to this point, give a reaction, something like a sweep, a break, maybe an inducement, then tap, go. You understand? So that's what we're expecting for next week. For now, we will just chill and watch price do its thing. So if this price action will still be bullish, we would know from the reaction it will give at this discount zone here. So cheers guys.